Thank you, Jamie. Today, you've heard about the lock-hold the Federal Reserve seems to have on interest rates in the United States, keeping short-term rates repressed at absurdly low levels, trying to push long-term Treasury rates, mortgage rates, and even junk bond rates down, and driving bond investors into riskier and riskier bonds in the hunt for yield. Now, this may be nirvana for some corporate borrowers, but it is absolute hell for income investors. So how long can it last, and when will it end? Well, the Bank of Japan has held interest rates down at ridiculously low levels for 20 years. Can the same thing happen here? Well, I've just returned from Japan, and I have also just debated this critical issue with Larry Adelson. And we agreed on the answer. The answer was no way. The Federal Reserve will not be able to hold U.S. interest rates down like they have in Japan. And the reasons, which we've discussed in earlier shows, are debts and currencies. In Japan, the debts are financed with domestic money. In the U.S., most of the debts are funded with foreign money. In Japan, their currency, the yen, has been going up for most of these years. In the U.S., our currency, the dollar, has been going down. And the dollar is now taking still another shellacking in the markets. If this continues, there's only one way the Fed can defend the dollar, can prevent an all-out rout in the dollar, and that's by raising interest rates. Now, for a while they will resist this and they'll neglect the dollar, but ultimately the Fed will have no choice but to raise interest rates. Remember, dollar selling by foreign investors begets bond market selling by foreign investors, and bond market selling can lead to a wholesale dumping of all dollar-denominated assets, not only bonds, but also mortgages, not only fixed instruments, but also stocks, not only paper assets, but also tangible assets like commercial real estate and residential real estate. And when the dollar falls, foreign investors take big losses, and foreign investors own massive amounts of U.S. assets. So what do if you must have higher yields, despite the dangers? For now, our experts have hinted at what may be a solution for some investors. Find high-quality yields with corporations that are solid financially, and then hedge against the risk of a bond market decline with inverse instruments. Now, RIDEX Funds offers a fund that lets you profit when junk bond prices fall, in other words, when their interest rates rise. So that may give you the best of both worlds, higher yields and a hedge against falling bond prices at the same time. Until next time, this is Martin Weiss with Money and Markets.